We're live, Chris?
I'm waiting. Yep, there we go. So
Okay.
the one's a little bit delayed, but now we are, so all good.
All right, so this is the meeting of the Finance and Audit Committee on Wednesday, March 23rd, 2021. Michelle, could you call the roll of members, please?
Yes. Jim Reffel.
Here.
Anna Marie Murray.
Here.
Alan Dale.
Present.
Brian Petrie.
Here.
And Sandy Levin.
Here. First item is approval of the agenda. Can I get a motion to put that on the floor?
It's Alan. I'll move that.
I'll second Anna Marie.
Thank you. I believe there are some amendments to the agenda. Ellen, do you want to speak to that in number 6? I think there's a date that's off.
Yeah, sorry. Took it over there. In the actual report, it made reference to being the year 2020, but it'll actually be in 2021 because it's not dealing with the 2020 audit. It's dealing with next year when we do the 2021 audit.
So you're moving that amendment in
Yes.
item 6, that it's course of action for the 2021 audit.
Yes.
Okay.
I'll second that, Brian.
Thank you, Brian. Michelle, could you call the roll on the amendment?
Sorry. Second. Sandy Levin.
Yes.
Alan Dale.
Yes.
Jim Raffel.
Yes.
Anna Marie Murray.
Yes.
Brian Petrie.
Thank you. And on the agenda as amended, please call the roll.
Sandy Levin. Oh, sorry. Jim Raffel.
Yes.
Sandy Levin.
Yes.
Alan Dale.
Yes.
Anna Marie Murray.
Yes.
Brian Petrie.
Yes.
Okay. Any declarations of conflict of interest? Seeing none. Minutes of the previous meeting of Thursday, October 15th, 2020. Can I get a motion to get those on the floor?
I'll move. I'll second.
Moved by, okay, thank you. Any questions, corrections? Seeing and hearing none. Michelle, could you call the roll?
Alan Dale.
Yes.
Sandy Levin.
Yes.
Anna Marie Murray.
Yes.
Brian Petrie.
Yes.
Jim Reffel.
Yes.
Okay. Election of 2021 Finance and Audit Committee Chair. I'll surrender the chair to Michelle to conduct the election.
So we don't have a formal election process because it's a subcommittee, but I will ask if anyone would like to put anyone's name forward as chair.
I'll nominate Alan Dale.
I'll second that.
Okay. Sorry, just a minute. Multitask. Okay. And does anyone have any further names or any discussion on that motion? Seeing none, I will call the roll. In a moment, once again, my list up, sorry. Alan Dale.
Yes.
Sandy Levin.
Yes.
Anna Marie Murray.
Yes.
Brian Petrie.
Yes.
And Jim Reffel.
Yes. Okay. Thank you, everyone. And Thanks, Sandy. You've been chair of this committee for several years now since it got going, and appreciate all the work you've done on the committee, and certainly look forward to you continuing on the committee. Next item we have is item number 5, which is an investment update from PH&N. And Christine, I don't know if you're going to introduce this, or do we have some folks online? Doesn't look like we do at the moment, but I'll turn it over to you, Christine.
They are in the meeting room, so when you guys want, you just tell me and I'll let them in. I just left them on their way
okay.
through the first steps, but I let them know we'd be with them in a minute. So
Yep. Do you have anything you want to say first, Christine, or do we let them in right away?
Yeah, only just a quick update. Our policy suggests that we should have an annual review of what's going on with the long-term portfolio, and that's what they're here to do. They have a 30-odd page slide set, so we'll have to keep them rolling through it to get on to the auditor discussion. So everybody can have lunch today, maybe. Okay, that's it. So
I'll let them in.
yeah.
Okay, thanks.
Christine, will it be a future meeting that we actually talk about the policy?
Yes, I think later in the year, maybe when we do, or later in the summer when we do look at an audit plan.
Okay,
I think it was every third year, so
yes,
in the
yeah.
fall. Yeah, we should be doing it this fall.
all righty.
Okay, so welcome to Leila, and who else we got here? Connor? All right, there we go.
Yep.
Hello,
Correct.
good morning.
Hello.
I guess we're almost noon now. Sorry to keep you waiting today. We're running a little bit behind schedule with our first meeting.
That's okay.
But we're here to receive an annual update, an annual report from you folks regarding our investment portfolio. So we'll try to keep this moving. We don't want to hold you up too much longer, but if you've got a report for us, you can hit the highlights. I'll just turn it over to you to give us a quick update.
Great. Sure. And how much time do we have for the presentation today? I know you're running behind, so we can shorten it if you like.
I say if you give us maybe 10 minutes,
Hello?
does that work? If 10 minutes and we can open up for some questions?
Yeah.
Okay.
Sure. No problem. No
Okay.
problem. We can do that.
Thank you for doing
Great.
that. I know it's
Connor, no, that's all right. It's okay. Connor, do you want to share your presentation?
Yep, absolutely.
Oh,
Bear with
does
me.
Connor hear me? Okay, great. Why don't you share the presentation? Because
Can
my
you hear me?
internet connection's not very stable. Yes, I can hear you. Great.
Okay.
So he's sharing his screen. Thank you.
Please let me know when you
Connor.
can see the presentation, Leila.
Okay. Okay, there we are.
There we
Great.
go.
So moving on to page 3, we always like to start with a bit of a humor, and the theme of lower yields has certainly been a theme that's driven a lot of our investment decision making on our outlook over the past year. And I know that I'm saying this while there's a lot of sort of content in the news about 10-year US 10-year treasuries going higher in yield, but yields are still low. A yield of 1.5%, 1.7% for a 10-year bond is still considered a very low yield, and this is an environment that a lot of our clients are grappling with. And in fact, on page 4, you can see that a majority of global sovereign debt is a majority of that is yielding less than 2%, and in fact, 26% of global sovereign debt has negative yields. So as much as we complain about our low yields here in North America, there are countries like Japan and Germany that have been grappling with negative yields, in fact, for quite a long time. So this is just a bit of a backdrop in terms of how the environment that we're operating in. And on page 5, we have the performance of the portfolio, and performance has been great over both the short and the long time periods. For the past 3 months, robust performance of 2.3% over the 1 year. I think a performance of 15%, it's fair to say, is a great performance for a 1 year period. And since inception, we've had on an annualized basis, so think of it sort of in simple terms, on an average annual basis, we've had a performance of just over 9% for the portfolio. So those are the absolute performance numbers for the portfolio. We are active managers, which means that our goal is to add value over and above the broad markets. And really the way we think about it is our clients have a choice. They can go out into the markets and buy an ETF, which is a low cost option. So if they're paying us a fee, they should be able to see some value added over and above the broad markets that also justifies our fees and also adds value to the portfolio. So in order to allow you to make that determination, we also set up a custom benchmark, and the custom benchmark is footnoted at the bottom of the page. It is fully representative of your portfolio. So you can see the index names. I think you would recognize most, if not all of them. And it's the allocation to the various indices is fully representative of the portfolio. So you can see that from the difference line, in addition to strong absolute performance, we have been able to add value on a relative basis as well. We've done better than the markets. I will say that generally this is a conversation we have when we have clients for over 4 to 5 years. We emphasize that our clients should focus on longer term performance. So generally active management is evaluated on a 4 to 5 year basis, but you haven't been our client that long. So this is what we have to work with. As a reminder for anyone who's new to the committee, we don't, our performance numbers are gross of fee. And the reason for that is all of our clients, while they're on the same fee schedule, the actual fee rate depends on the client's portfolio size. So we have footnoted fees at the bottom of the page. Fees annually are 62 basis points, and these are the all-in fees. There are no extra fees or embedded fees in the strategies. Before I go ahead, I just wanted to just pause and confirm that there have not been any changes to the organization's investment objectives, or if you have any significant cash flows that are coming up, I think it's a good time to discuss that, because if it requires changes to the portfolio asset mix, then we should be informed.
I don't think there's any changes. Anything there you need to mention, Christine?
No, I'm not expecting any significant changes for probably more than a year.
Okay, great.
Good,
Thank you
good.
for that. So on page 6 is a snapshot of portfolio composition, and you can see the portfolio composition. The areas that are in blue are bonds, effectively. So anything that's in blue is some segment of the bond market that you're invested in, and anything that is in green is Canadian equities. Anything that's in orange or brown is equities outside of Canada, so global equities and emerging markets equities. So broadly speaking, your portfolio has about a 40% allocation to bonds and about a 60% allocation to equities. Within equities, we do not have a bias to Canadian equities, and for reasons that I have spoken to in the past, the Canadian equity markets are not as well diversified as global markets, so we have less in Canadian equities than we have in global equities. And you can see that also within Canadian equities, we diversify within the large cap and the small cap segments of the markets, just to get better diversification to segments of the market that are not as well represented in the large cap segment. A couple of new changes in the portfolio that we implemented. First one is on the Canadian equity front. So when we did the shortlist presentation for UTRCA, there was a preference for strategies that are fossil fuel free. And at the time we spoke to you, we only had that capability in global equities. So your global equities have always have been fossil fuel free. We didn't have the capability in Canada until recently. We recently launched a fossil fuel free low volatility Canadian equity fund, and when that became available, we put that in your portfolio. So we switched out the large cap Canadian equity that you had, and we put in the fossil fuel free strategy instead. So that is the first change. And the second one is with Canadian equities, you have a 25% benchmark allocation to Canadian equities, and we have reduced that tactically by about 4% to about 21%. And again, this is part of our effort to have more global exposure, just for better overall long-term performance in terms of stability and consistency. And I'll speak to that in a bit. On page 7 is a snapshot of where we think we are in the business cycle. And interestingly, I think that if we had shown you this chart in late 2019, you would have seen a lot of the gray boxes at the late cycle to end of cycle segment of that page under the yellow and the orange. Very different story today. We've gone through a recession past March, and we've come out of it. Depending on what indicator you look at, we believe we're in the start of cycle to early cycle environment. And again, this view on where we are in the economic cycle drives a lot of our investment decision making in our client portfolios. In the interest of time, I'm going to skip a few slides. So maybe, Connor, maybe if you could go to page 9, we'll start there for a couple of slides on equities. So on page 9, we wanted to just show how different market action has been, particularly in Canada compared to globally. So what you see on page 9 is global market performance. The dark blue bars are for the entire year 2020, and then the yellow bars are for year to date in 2021. And you can see that Canadian equities, in fact, it's interesting to see year to date, they've been the best performing market. But when we looked at them for the entire 2020, they were the worst performing market globally. And the reason for that is, of course, heavy concentration in banks, which kind of suffered in a lower rate environment, and heavy concentration in the energy sector, which suffered from lower oil prices for a majority of 2020. We only saw oil prices bounce back in November of 2021. So with that, also, if we look at the right-hand side of the chart, we can see that the performance of the various segments of the Canadian equity markets, information technology, that is Shopify at the top, the blue bar at the top on the right-hand side. You can see that one name, one company, Shopify, really drove the Canadian equity markets in 2020. And conversely, in 2021, we've seen it pull back. And in fact, when we look on page 10, just highlighting the concentrations that we see, not just in the Canadian equity markets, but in the global equity markets. On the right-hand side of page 10, you can see that if we were to take the performance of the Canadian equity markets for the year, for the full year in 2020, if we were to take out the outsized impact of Shopify, which was one stock really driving the market, and of course the gold sector, we did see gold do really well for part of last year. If we were to take those two influences out, the Canadian equity markets would have actually had a negative return. So instead of a positive return of 5.6% for the year, they would have had a negative return of -1%. And this again highlights how you can have small segments of the market really drive the market. Bit of a similar story, not to the same extent, on the global side, or on the US side, I should say, where we saw a concentration, of course, in the technology sector, with the tech sector driving the market. And you can see that on the left-hand side of the page, where the S&P 500, one-year return of 16% for 2020, phenomenal return. When we take out the outsized performance of the tech sector, so FANG, I don't know how to say that anymore. It used to be FANG, and now we added Microsoft. So it's the Facebook, Amazon, Alphabet, Netflix, Microsoft, and Google. And when we take those out, the market would have had a much more, I would say, moderate return of just under 7%. So again, these are things that we look at as investors, and we particularly look at concentrations. There's been a lot in the headlines about bubbles in the stock markets, and we would say there isn't an overall bubble. There are bubbles in particular segments, and we're not just seeing that in North America. We actually see it in the Chinese equity markets as well. There are particular segments of the markets that are frothy, and other segments that are we still think there could be good relative value found in those segments. In the interest of time, again, I will skip a page. I will go to page 12, just very quickly. I'll go to page 12. I wanted to highlight sort of a resurgence that we saw in renewable names over the past year. And I wanted to specifically highlight this again because of your portfolio stance with regards to fossil fuels. So interestingly, historically, whenever we've seen oil prices go down, with it, we've seen renewable energy companies go down. And the reason for that has sort of the conventional wisdom is that if oil is cheap, why switch to renewable energy? This time around in 2020, a different situation emerged where we saw the price of oil declined, but renewable energy companies actually did quite well. And in fact, on the right-hand side chart of page 12, the second name, Ørsted, that you can see on that page, that was the largest contributor to performance in the global equity portfolio, which is about 40% of your portfolio. Sorry, about 37% of your portfolio. And Ørsted is a Danish wind farm company. They used to be an oil and gas company, and they completely transformed themselves into a renewable energy company over the past decade or so. And in fact, it has been a long-term holding in our global equity portfolio and had the largest contribution. So we think that this reversal in the correlation between energy companies and renewable companies is sort of heralding perhaps a bit of a new structural change in energy landscape where even if oil prices have gone down, we're still seeing good returns from renewable companies, because we see entire countries and municipalities and companies talk about reducing their carbon emissions and being carbon neutral in X number of years. And we think that structural change is going to continue to do well for renewable energy companies. So with that, I think maybe I'll close off with just a couple of comments on, I'll skip fixed income. I think I've spoken to fixed income before in terms of the yield environment being where it is, but maybe I'll close with pages 21 and 22, which is our outlook on the markets. And, you know, again, the question we get from our clients is the market overvalued or undervalued? And we don't have a perfect answer, but I think we have a reasonable answer. And that is, it depends on how you look at the markets. And in fact, a lot of the models that you see quoted in the news media, so, you know, the trailing price earnings or the Schiller PE, those are some of the favorite models that you may see quoted in the media. They tend to be single factor models. They look at a single factor to determine whether a market is overvalued or undervalued. And when you look at single factor models, as you can see on page 21, depending on model you use, if you're only looking at a single factor, you can actually arrive at varying conclusions. So if you look at trailing price to earnings, you know, this is as of mid-January, the market would have been overvalued. If you looked at the Fed model, which relies on interest rates, the market would have been quite undervalued. At RBC GAM, we use our own fair value model, which is a multi-factor model. So we look at a variety of different indicators, market specific and also some macroeconomic indicators as well. And based on our indicators, the market slightly expensive. Certainly, again, as I mentioned, overall market slightly expensive. There are pockets of overvaluations and pockets where we think there are fair value opportunities. But overall, we think that there's certainly room to grow for the market in the context of significant excess slack in the economy, significant unemployment, and that is why we are overweight equities in our clients' portfolios, including yours. It's driven by this view that there is still room to grow for the equity markets. And in fact, moving on to page 22, our earnings forecasts is in line with consensus, where forecasting somewhere between 19 to 20% earnings forecast for 2021, and also again double-digit earnings forecast for 2022. And I appreciate that this comes on the back of a roaring stock market for the past year. But again, when we think about it, there are segments of the economy that have been completely dormant for the past year, and those segments of the economy have not participated in the equity market. So as we see the pace of reopenings and vaccinations accelerate, we're going to see those segments come to life. And of course, you know, the poster child would that be, for example, the travel segment. So so that is why we're still constructive on equity markets and have higher equity allocation in our portfolios. So that's all I had to say. I think I'm probably about 3-4 minutes over time, but I'm happy to answer any questions.
Okay, that's great. Thank you, Leila. Lots of information there. Anybody on the committee have any questions or comments regarding the?
Yes, I think there's a few hands up. Yes.
Okay, let me just click here. Okay, Sandy, go ahead.
Thank you, Mr. Chair. Through you to Leila. I seem to recall last year about this time you had talked about stocking up on some good quality bonds that at least in the short-term yields had really spiked high. Is the intention to hold those to maturity or to sell them for capital gains?
So we've actually sold some of them. So not all of them have been sold, but some of them have been sold. And I think the best way to address the question is maybe if we were to look at slide 18. Yeah, thanks, Connor. Slide 18 is a good one. So slide 18 shows the various segments of the bond market and how the level of compensations that investors have received over time. So whenever you see a spike, it means that the price of the bond went down, effectively saying investors are demanding compensation for holding the bond. So when you look at where Connor's doing the swirl with cursor, the spikes that we saw in March of last year, that is when we saw significant dislocation in the bond markets. And at that time, we actually added to our corporate bond exposure and to our high yield bond exposure because we saw significant dislocations in those segments of the market beyond where we felt a lot of bonds were below fair value at that time. And you can see that since then, the spread has gone down. That means investors have reduced the level of compensation they demand What that means is that the price of the bond has gone up. So as the price of the bond has gone up, we actually did take off some of those positions, not all of it. We still continue to keep some of those exposures, but we did take some of that off. And that has worked out very well for the bond portfolio. So the investment grade bond portfolio that you have, the 1 year return, I don't have the December return, I have it as of February, but as of the 1 year return as of end of February was over 3%. So it was 3.4%. Again, substantially, you have December, Connor, thank you. 1 year return as of the end of December for the total return bond fund, which is the fund where when we implemented that strategy, and a return of 11%, which is, I think a return of 11% from a bond fund is quite substantial. Generally, we see those returns from equity funds, not of bond funds. So yes, the strategy worked.
So in terms of our 60-40 split, we certainly should probably expect a lower return on the fixed income portion. But for us, are you still comfortable that 60-40 is the right investment policy for us to pursue going forward?
I would say that at this point in time, yes. And the reason for that is your 40% in bonds is quite nicely diversified among various segments of the bond market. So with that diversification comes a better yield. So when you look at the pie chart there, you can see the universal, that is the total return bond fund. I told you it's all investment grade bonds, various segments of the bond market. The mortgages are far less interest rate sensitive than the other bonds you hold. And despite that, they have a higher yield. So you get that yield benefit from the mortgages. And the high yield bonds are also less interest rate sensitive. And in fact, we think the bond portfolio is well positioned because if interest rates were to rise, I mean, eventually they will, probably not until 2022, maybe late 2022, early 2023. But if interest rates were to rise, then high yield bonds have been historically the category of bonds that have held up nicely in a rising rate environment. We've seen government bonds not hold up nicely in a rising rate environment. So I would say you have a nice balance of strategies to do that. Having said that, if the committee feels strongly about reducing its bond exposure, we're absolutely happy to do that. Majority of our clients do have somewhere between 30 to 40% in bonds. I would say given your diversification, 40% is okay. If the committee feels strongly, we can reduce it to 30%. Obviously, we'd need a new investment policy statement, but we can take care of that.
Thank you, Mr. Chair. I'm done.
Okay, good. Thanks, Sandy. Christine, you have some comments, questions?
I have a question which ties into what Sandy just asked. So if the equity market now by RBC's multi-factor grading is slightly expensive, were we to have an additional investment, you would be slightly hard pressed to find not too expensive equities to add to the portfolio?
No, I wouldn't say that.
Okay.
I wouldn't say that. So we would invest according to our mandate. We are active managers, so we don't buy the market. We invest in particular corners of the market. So acknowledging that there are segments of the market that are expensive, there are other segments that are not. So a great example of that is the global equity fund that you're invested in. It has had a phenomenal return. What is the 1 year return, Connor? What is the 1 year return for that fund? I have it here, sir.
37.9%.
Yeah, so okay, there you go. So the global equity fund that you're invested in, that one. That one is 38% return for the past year. Many of our clients think that 38% return came from us being overweight technology. That is actually not the case. The strategy has been underweight technology. So most of the return has come from good stock selections in other segments. So, when you're an active manager, you identify where the bubbles are and you try to find opportunities outside of that, is what I'm trying to say. So I wouldn't worry about that.
No, I'm not particularly worried, but it's interesting to hear that you have ways and means of finding, as you say, pockets of equity investments, even when the market is starting to look perhaps a little expensive. That's all.
Yeah,
I just wanted to ask about potential future investment, maybe.
Yeah, absolutely. I can go more into more detail on that, but I'll leave some time for the next question.
Yeah, and
Cool. Connor,
Well, I was going to say, Leila, I mean, if there are no further questions, you can maybe talk about how we go upstream within the supply chain to
Yeah,
maybe avoid.
I was going to talk about that, but I think there is another question. I see another.
Let me get Brian first. Brian's got a question, and then we can go with that.
What's your view on the inflationary pressures on our bond holdings? Will the returns outweigh inflation, or is that just an unknown at this point?
So no, that's a great point. And inflation certainly has been in the news a lot. So our view is that there is inflation, but in certain segments of the economy. Again, I mean, there are stories of ports in California not being able to move products, ships waiting in the sea. I think everybody agrees meat inflation has gone up. There have been pockets of inflation, and of course, energy inflation in energy prices. So there have been pockets of inflation. However, and a lot of news media and a lot of our clients relate the possibility of a higher inflation to money printing by the governments. But actually, when you look at it historically, there is a weak link between monetary policy, printing money effectively, and inflation. The stronger link is between inflation and unemployment. So the Federal Reserve's stance, I think, has been quite clear. And in fact, in August, they made it extra clear that they are targeting average inflation of 2% over time. And that was a nuance in the wording, but probably one of the most seminal announcements of my lifetime, at least, because it effectively said that the Federal Reserve is not going to raise interest rates as soon as inflation starts to tick up. They are mindful that inflation is elusive, and they're probably going to let inflation run before they raise rates. So we might, based on what they said, it is very likely that you could see inflation even go above 2% before they raise rates. In terms of inflation, we think that in the short term, inflation is not going to be an issue, again, because of the significant excess slack and unemployment levels in the economy. And some of the pressure areas have actually been, we've seen some of the pressure being taken off from particular areas where we saw inflation. And again, like speaking of localized inflation, there's a shortage of semiconductors, and that for a variety of reasons, there's a shortage of semiconductors. So that's another area where we see inflation. But broad inflation remains elusive. There are demographic trends that again discourage that inflation, automation trends that discourage the inflation. So we don't think that inflation is as much of a threat, perhaps, as a lot of news media is spilling ink on. And the Federal Reserve, I think, has done a fair job of coming out again multiple times and talking about that. The way the market has reacted to like inflation ticking up is the way the market would have reacted previously. So before, when the Federal Reserve targeted 2% at any given point in time, obviously bond yields would start to tick up as soon as inflation went up. The market, we think, just has to learn how to react to the new Fed policy, which is inflation might tick up even over 2% before the Fed raises rates. So it's just, we think it's a bit of a learning process for the markets to get there.
Sorry, I was muted there. Any follow-up, Brian? Are you okay?
No, I'm okay with that.
All right. That seems to be it for questions then. So, Leila, you were going to explain a bit more to us.
Oh, yeah. So just to, again, emphasize sort of how we think about investment management, you know, a good example is if you look at a company like Tesla. So, you know, I think by any measure, the valuation is quite high. We would agree that certainly the market for electric vehicles is real and a growing market. And certainly it makes sense as investors to be invested in the market. Tesla itself is not a company we would invest in for valuation concerns. And again, this goes to pockets of overvaluation of the market. However, what we do is we go down the supply chain and we invest in suppliers to the electric vehicle manufacturers. So we invest in companies that supply not just to Tesla, but to Volkswagen or Audi or other companies that are also manufacturers of electric cars. Or with online shopping, we would not necessarily invest in a bunch of online only retailers, but we would invest again in those that supply to them. So one of the longer term names in the portfolio has been DHL, which is a delivery service. And it has done phenomenally well over the past 6 years. We've held it because it's been a beneficiary of the trend in growth in online shopping. So we look for this broad trend, and we try to go down the supply chain to find companies that can support that multiple providers of that trend, if that makes sense.
Very good. Good. Any other questions or comments? Seeing none, can I get a mover to accept this?
I think
investment
Brian had
report?
another.
Oh, Ryan?
Sorry, I saw Brian. I
Yes.
raised his hand again.
I was just going to make a comment. This is my first meeting on the committee, and I just want to say that I am impressed with your knowledge and scope. And so I feel very good about where our money's at.
That is very kind of you to say. Thank you so much. We'll do our best not to disappoint in the future.
Yeah, very good. Yeah, Brian's the only new member of the committee, but certainly the rest of us are still, I think we're always learning. There's always so much to learn when it comes to financial matters. So lots to find out here. And I don't
We
see
do
any
too.
other.
I think Connor and I learn every day.
Just when you think you've seen it all, something new comes along. Yes.
Oh, you've never seen it all. Yeah.
I don't see any other hands. So can I get a mover to receive this investment update from PH&N?
It's Sandy. I'll move it.
Moved by Sandy, seconder.
I'll second. Anna Marie?
Anna Marie, okay. And if there's no further comments or questions, Michelle, can you do the roll call, please?
Sorry. Alan Dale,
Yes.
Sandy Levin,
Yes.
Anna Marie Murray,
Yes.
Brian Petrie,
Yes.
Jim Raffle.
Yes.
All right, that's carried. Thank you very much. And thank you, Leila, to you and Connor for your presentation. Always appreciate the information, and I hope we didn't rush you too much there or hold up your day too much, but
All
certainly
good.
lots to hear, and the committee can certainly review this information at our leisure. And again, I just echo Brian's comments. When you look at the performance there on page 5, looks like we're in good hands and things are going well right now. And we can certainly have some future discussion, but for right now, it looks like things are going well. So
Thank you. Thank you for having us. Thank you for the kind words, and have a great day, everyone.
thank you. You as well. Yep. Thanks.
Take care.
Take care.
Thanks very much, Leila.
Yep, thanks. Okay, that takes us down to item number 6, which is our closed session. I don't think we have anything else before that. So can somebody move that we go into closed session?
I'll move.
Moved by Jim.
Second.
Seconder. So is that
Sandy.
Sandy? Okay,
Yeah.
thanks. Any comments or questions? I'll call for the vote. Michelle, can you do the roll, please?
Alan Dale,
Yes.
Sandy Levin,
Yes.
Anna Marie Murray,
Yes.
Brian Petrie,
Yes.
Jim Raffle.
Yes.
Okay, so that's carried.
Okay, so
Now
I'll
going
stop
to-
the live stream then. Sorry, bear with
Yeah.
me for 1
Yeah,
second.
please.
Sorry, before you get.
Item number 7 is next meeting. Christine, how's the audit coming and how soon do we need to meet again?
We'll probably have to meet in about a month's time to review the draft statements from Deloitte before, well, to review them with Deloitte, be satisfied with them, and then they can go to the board meeting in May. That's generally been our habit. So I hope to have my first look at the drafts in another week or two. Look for typos and that sort of thing. So probably a month.
So we could meet same as this, meet right after the board meeting in a month's time in April.
If it suits the group, sure.
Does that work best for folks, or what? If we
Certainly
do-
works best for myself.
Yeah, it works for me well too. No, that's
Okay. You're okay with that too, Sandy?
Yep. I just looked. So April 27th.
Okay. Yeah, that seems to seems to go well if we can put stuff on one day, and that way it doesn't tie up 2 days for people. So, so let's schedule this then for April 27th, following the regular board meeting, and we can get an update then on the audit and do what we need to do. Item number 8, other business. Anything else we have to do today?
I have one bit of information which this group might be interested in.
Sure, go ahead, Christine.
Quickly, late last week, I had a call from our bank, who is effectively May 1st going to reduce the rate that they pay on our current account by 10 basis points. I was told it was going to be reviewed in 6 months by the bank, but the letter that followed the phone call didn't say anything about a review. So, yeah, it's only 10 basis points, but it's still something. I mean, we're seeing rates moving in different places, but the agreement that we've had with TD goes back at least 8 or possibly 10 years as it stands. But they're looking for another 10 basis point spread on so that they can keep making money.
And I'm assuming this is money that we need to keep liquid and have on hand in the bank account.
Yeah. So it's maybe $4,000 or $5,000 a year to us difference loss. So
Means more to us than it does to them, but anyway.
Anyway, I just thought I'd pass that on because it just happened late last week.
Yeah, no, it's good to know.
Christine, when we've obviously been with them, you said for 8 to 10 years.
We've been with them since 1948.
Okay, so there's a question of, is there value in exploring that, not in the near term, but in the midterm or whatever, are we receiving value from our institution still?
There's always value in reviewing who you're doing business with. I did a loose survey maybe about 3 years ago. We participate with other conservation authorities in very loose polling for this kind of thing. And at that point, we were not paying exorbitant fees, and we're still not. They really haven't changed that much in 3 or 4 years. Other banks are charging higher fees to other CAs. So,
Okay.
and then we went through in this long-term investment portfolio review. We invited TD to bid on that, and yes, we can look at that.
I guess it's always just about due diligence. I just don't want to be caught, saying, oh, well,
Yeah.
no, we've been with them for 40 years or 60 years. And all of a sudden we could have, we have a responsibility as well to make sure that we're looking at that.
Well, maybe once we get our auditor in place, we might have an opportunity then to take a look at our banking situation as well.
They might sharpen their pencils a bit.
Well, they are sharpening their pencil, that's for
Yeah,
sure.
their pencils, or dull their pencils a little bit.
Yeah. It could be interesting to see if this does get reviewed in 6 months or not.
Yes, no doubt.
And which way it gets reviewed. Okay.
All right. Anything else then? Seeing nothing, all we have left is motion to adjourn.
So moved.
Moved by Sandy. We are adjourned. Thank you very much, everyone. Appreciate it.
Everybody.
Yep. Thanks.
Thank
Take care.
you.
We'll talk to you soon.